a tug of war between how long do you want the loan to be, because you might not want to be in that loan for a long time. But there is kind of a pendulum that swings as the market swings from fixed to floating or bridge.
Hello, and thank you for joining us today on the Gentle Art of Crushing It show, where we focus on learning and sharing with our listeners all there is to know about how to create success in our lives. This show stands on the shoulders of giants. Our mission is to empower and inspire our listeners to create the life of their dreams whilst having a blast in the process. Let's celebrate life together. Welcome to the show.
Right. Welcome back to the Gentle Art of Crushing It podcast, Passive Investing Edition. My name is Randy Smith, and I'll be your host today. And I'm really excited. We've got a little bit different show today than what we've had in the past, but we've got an expert in lending. We have David Frasz, who is the Director of Nationwide Multifamily Direct Lending at Lument. And he's got just a ton of experience in this space. And I met him at a conference recently where I saw him interacting with a ton of people that I know, like, and trust. So I think we're in for a great conversation to learn all about lending. But David, welcome to the show.
Yeah, thanks, Randy. Glad to be here.
Awesome. Well, why don't we just jump right into it? Can you tell us a little bit about yourself, kind of how you found yourself becoming an expert in this lending space, in the wonderful multifamily space?
Yeah. It's been a ride now. It's been almost a decade. Becoming an expert takes time. It certainly made it a lot easier with passion. So I was working early in my 20s out of college. I was working in banking and a number of different investment banks, and just kind of found myself looking for more and not really having the path, the direction that I wanted to really throw myself 100% into it and make something of myself. And so I started searching around, and through a lot of networking, I eventually ended up seeking out real estate roles. And I had never thought about real estate. I come from a really small town where the only exposure to real estate was being selling homes to your neighbors. And that wasn't something that particularly interested me. I'd always been interested in investments. And so as soon as I started looking at commercial real estate, I had a job at a now competitor of mine. It was just a couple of weeks. And once I got in there, I fell in love with real estate and underwriting and how to make the numbers work and how to make money in real estate. And I just kind of parlayed that into what I'm doing now, which is direct loan originations. I started out kind of on the underwriting side, spent 3 to 4 years underwriting multifamily and other asset classes. And during that time, I started brokering loans as I was talking to everyone and building relationships. And I kind of just decided at that point I had to make a decision to keep underwriting or to move into loan origination. And so that's what I've been doing since. And that's how I meet folks like you and other people, by kind of getting out there and doing good business for people.
This is Chad Ackerman, founder of Left Field Investors, and I'm inviting you to listen to our podcast, The LFI Spotlight. Tired of the Wall Street roller coaster? Discover how to invest in real assets as I interview syndicators, seasoned passive investors, and other experts every week. We'll help you learn about cash flowing syndications, bringing you closer to financial freedom. Visit leftfieldinvestors.com to listen to the podcast, subscribe to our newsletter, and connect with like-minded passive investors. Join us today.
Thank you for kind of walking through that. It's always interesting to hear those first few years, because I don't think anybody really knows what they're going to do when they get out of college, and you kind of bounce around. But inevitably, it sounds like you landed at a really good spot with something that you love, you've got a passion for. And from the response that I saw that you were getting from a lot of folks at the convention, you're very good at what you're doing as well. So that's kind of the reason why I wanted to have you on the show, is this idea of, underwriting deals and getting the lending around these deals is something that the passive investor needs to know better. They probably don't need to be an expert like you are, but they at least need to know how to ask the right questions, understand the intricacies of the different offerings, and just have a general overview. So I'm curious, can you maybe kick it off with talking a little bit about, a multifamily operator comes to you, they've got a great deal. like what kind of options are they choosing from, at least initially? Are there a couple of buckets or a few different types, or what does that look like?
Yeah. So the angle that I would approach this question with is actually from the passive investor standpoint. What do you want your general partner, your syndicator, to? What kind of conversations do you want them having with their lender? And the answer is, you want to be talking about loan term and how that fits with the business plan, whether it's a 2-year kind of quick rehab and refinance, or whether it's a buy and hold for 5 and then sell, or maybe it's a long-term hold and hold it for 10 plus years with potentially a refi in there, but not necessarily. So a lot of those things, it really, a lot of the conversations with a deal, when I'm just starting out on any deal with a client, is what's the business plan? How long do you want to own the property? But also importantly, how long do you want to own the loan? Because they're two separate things. So you may want to own a property for 10 years, but that loan may only be good for you for 2 years. And we need to make sure we structure the loan accordingly.
Got it. So it's really business plan, which is going to drive the loan. I'm sure with a combination of what's going on in the marketplace, that might drive what the business plan is. But then when they come to you, they've got to have an idea. So interesting. Okay, so I know there's a lot of talk about, a lot more talk about this most recently than it was maybe 2 years ago. But this idea of fixed rate or floating bridge loans. Can you provide some insight on kind of those two broad areas?
Yeah, so the story of up until about 12 months ago, the story was really, or maybe 18 months ago now, but the story was really about bridge debt and floating rate debt, whether it be a traditional bridge loan, whether it be hard money, private money, or just a floating rate, Freddie Mac loan or something like that. And the reason is because all of those loans are based on an index, and the index is call it, let's say, SOFR rate. Well, those were all down near zero. And so all you were really paying for in your rate was the spread, whether it be the spread on Wall Street that Goldman Sachs or Bank of America or whoever wanted to buy the note for, or whether it was the spread of a balance sheet lender that needed to get 400 basis points spread to make profit on the deal. And so everyone wanted those because they were very flexible, high leverage, and the rates were basically almost as low as permanent loans that would lock you in for a lot longer period of time. As those index rates rose, those rates have risen. So the same terms, a 4% bridge loan now might be 9.5%. Same deal. Fixed rate, I think, is always a winner in terms of certainty. And I think in our business, certainty sometimes gets undervalued when you're trying to make a deal on the way in. But the reality is, the more certainty you have all along the way, the better off your deal can go. And I think right now, people don't want floating rates because the rates are essentially just as high, if not higher, than the fixed rate loans. And so we've kind of had that swing back. Of course, there's a tug of war between how long do you want the loan to be, because you might not want to be in that loan for a long time. But there is kind of a pendulum that swings as the market swings from fixed to floating or bridge.
Got it. Okay. Yeah. Thank you for that. It's interesting. Have been a passive investor just simply during the times where bridge debt was all the craze. Everybody was using it. I would hear these people rumbling about fixed rate debt on the sides, but it was almost like those guys are a little crazy because why would you ever do that? We're always going to have low rates and what have you. But guys like yourself, you've been through the cycles. You've seen what happens, and I think that's really kind of cause for some of the issues that we're seeing today. There are a lot of folks that got bridge loans that had floating rate debt that, as the rates increased, it got pretty scary for them. And you mentioned rates going from, call it 4 to even 9, essentially doubling your bill overnight, or relatively quickly. So now there are some tools, though, that some operators use to kind of decrease the risk of a floating rate. Can you talk about those a little bit?
Yeah. So, I mean, the one is going to be your, obviously, just the way you structure the loan. So if you structure the loan with, lower exit fees, or you structure a loan with um, a longer fixed rate term, if it's kind of a hybrid type loan. The big one is really rate caps, but that can bite you as well. So most bridge lenders that do floating rate debt, that's kind of institutional bridge lenders, not always on kind of the smaller bridge lenders, but if you're doing kind of an institutional bridge and you're getting really the kind of the lowest rates and the most detailed underwriting, most of those lenders, including us, are going to include a rate cap or require a rate cap. So you pay some amount to a rate cap provider, which is generally a third party, and they say, we will guarantee that if your rate goes, let's say the prevailing rates are 5%, if the rate goes above, 4%, if the rate goes above 5 or 5.5%, everything beyond that we will eat. And rate caps were very inexpensive up until about, I don't know, 18 months, 2 years ago. You could buy a very good rate cap that kept your rate very low for tens of thousands of dollars, whereas today it might be hundreds of thousands or millions even. So it, of course, depends on the size of the deal, but it's essentially a financial instrument that has value. It's like an option. So the problem with that is most of those have expirations, and sometimes the expirations line up with the maturity date on the loan, and sometimes they don't. Sometimes they have sort of extensions where you have to kind of re-up, or you have to pay to extend it, and that might be, the terms of that might change the instrument, in which case you're essentially getting kind of a new terms on that rate cap. So what we've seen actually is a lot of people are trying to beat the buzzer now, and over the next 12 months, they're trying to beat the buzzer and either do a refinance or sell a property before their rate caps increase or expire, which means either way, they're going to likely see higher debt service.
So essentially, a rate cap is an insurance tool that the operators are using to ensure that the rates don't increase. So I'm curious if there were all of these third party rate cap providers with interest rates doing what they're doing. Are those companies at risk now of defaulting?
Yeah, unfortunately, I don't know the answer to that, but what I can say is I'm still getting emails from all of the same cap providers that I was before. So it doesn't seem like they've gone away. But part of that may be, again, just like the insurance business, like you said, you don't necessarily, it's not everything is on a fine line where one day the faucet just turns on or off, or the door opens or closes. So as the market was changing, they were still providing rate caps, but those rate caps again were much more expensive. So I mean, the numbers are, really, really stark. Like I said, a rate cap that might have cost $20,000 a couple of years ago might be 300,000 today. I'm not all that fluent with the rate cap market, but essentially it is pricing in risks of increased rates. So
That makes a lot of sense, and it's good to hear that all those same players are still in the marketplace, because that would add another layer of risk that I don't hear talked about. So that's interesting.
one interesting thing about rate caps, which a lot of people don't necessarily know, because if you sell your home or your property, your insurance policy goes away. You no longer have insurance for that property. Rate caps, like I said, they're a financial instrument. So even if you sell the underlying asset, you're still entitled, the way they're structured, to compensation for the rate differential. So I actually have had clients who have sold properties where they had a rate cap, and the rate cap was purchased very inexpensively. They kept the rate cap and continued collecting monthly payments from the rate cap provider. So it is an interesting how that kind of financial product works. But ultimately, you're right, it functions like insurance as well.
So my understanding was if you sold the asset, you could move that rate lock or rate cap to another asset, but you're saying you can actually just hold on to the rate cap as its own independent asset and continue to take income from that tool?
Essentially, because it has an expiration. It's not in perpetuity, but it is for a defined period of time. And the way it's structured would be, if this rate goes above X, this is how much you get paid monthly. So it's an interesting. It kind of blew my mind when I first heard about it, especially with the numbers that were in this particular case, which was it was purchased for a minimal amount at the time.
Yeah, and so it could make sense if somebody's selling an asset that has a good interest rate with a cap, they could sell the cap along with the asset to the purchaser then. Interesting. Mm-hmm. Okay. Yeah, so that's a whole different twist that I haven't thought about. So now I do understand too that with rate caps, you hear a lot of people say, well, we've got a 3-year or a 5-year rate cap, whatever that may be. We're good for those 3 years. But my understanding is like the lender is just as concerned about the end of that term coming and you not having the rate cap. So they're doing some things to make sure that you're prepared to buy another rate cap as well. Is that correct?
Right. Yep. Just like a lender might hold back for taxes and insurance, escrows for next year's taxes, based on projected preliminary tax assessments, et cetera, or increases in insurance. They will do the same with a rate cap. So if they know that the cost of a replacement rate cap is going to be $100,000 and it's coming up in 12 months, then they might start escrowing, pro rata share per month with your payment, so that when comes time for that rate cap, they have the funds to purchase that cap to make sure that the loan itself is not in jeopardy any more than it should be.
Got it. Okay. Yeah, no, that makes a lot of sense. And I think that's where we're seeing a lot of people get in trouble and we're seeing distributions paused and potentially even capital calls occurring because they're coming to the end of their initial term and there's nothing on the horizon saying definitely rates are dropping or stabilizing for sure. So the banks are wanting to make sure that they're protected because ultimately at the end of the day, the bank and the lender is the largest investor in these assets. So their interest is to make sure to preserve capital just like everybody else's, right? Okay, so bridge loans, great. In certain environments, you've got this rate cap tool that you can use. Why doesn't everybody just use bridge lending with floating rate debt and interest rate caps? Like, why would you ever use fixed rate debt for longer term?
Yeah, so, well, for starters is, again, the certainty aspect. Bridge loans, floating rate debt. I mean, even if there's a rate cap, it doesn't mean it's capped at the rate that you close the loan. So you might be able to get a let's say years ago you could get a 4% floating rate bridge loan. It might be 4.25% for a fixed rate or 4.5% for a fixed rate. You want the lower rate, but if you value certainty and you don't want your rate increasing, you're looking into the future, you would want that fixed rate. Additionally, if you don't plan on doing a refinance or selling, so a kind of a capital event, if you don't plan on doing that in the first 2 to 3 years, then it's likely that bridge financing isn't going to be your best option to begin with, because typical maturities on a bridge loan are going to be 2 to 3 years.
Okay. No, that makes a lot of sense. And from what I understand, though, there are some additional drawbacks to the fixed rate long-term loans in that there can be, I use the term prepayment penalty or defeasance, or there's some other term as well. Can you kind of walk through that as well? Because that's something that needs to be considered too, right?
For sure. So that's kind of what I was discussing earlier when we're talking about lender meets general partner and you're talking about how to structure the loan, it's really important to nail down the business plan. And if oftentimes it's not black or white, there's some gray area. And in my position, I can't make that decision for the borrower, but it's my responsibility to have that discussion and say, hey, how long are you thinking you want to own the property? How long do you think you're going to have this loan? Do you think you're going to refi in 2 years after you've added value, or are you going to ride it out until maturity, maybe 5 years, 7 years, 10 years, something like that? And that really matters, because what you described is, we call it the prepayment penalty structure. And there's defeasance, there's yield maintenance, there's what we call step down or declining. There are variations of that as well. But defeasance and yield maintenance are the most costly to the borrower to prepay. And the reason is those are slightly, they're different, but they're essentially replacing the yield to the owner of the note for all of the payments that they would have received. So in the case of defeasance, defeasance is used when the loan has been put into a large multi-loan security. And so in order to maintain the yield of the broader security, you have to essentially, if you're going to take that loan out, you have to put another instrument in its place, and that instrument has to have the same yield. So essentially you're basically just paying off the loan by essentially giving that yield to the underlying note holder. Yield maintenance, similar, but there's a somewhat complex capital markets calculation that has to be done that changes day to day based on prevailing market rates, time to maturity, et cetera. So the thing to keep in mind for everybody, limited partners, GPs, is that yield maintenance and defeasance are very unpredictable, and they can be very, very expensive to prepay. It could be 12, 14% of your unpaid balance to prepay a loan, depending on how long it is to maturity and where rates have gone. For example, yield maintenance is, if rates go down from when you originate the loan, that means that the MBS investor who owns that note has to then, if you pay off your loan, they have to accept a lower yield on their money. So you're making up for that shortfall. So the best prepayment structure, if you have a predetermined payoff date, whether it's a refi or you're going to sell in 4 years or something like that, the best prepayment structure to consider is the step down or the declining, which is going to generally be some variation of like a 5, 4, 3, 2, 1 or something like that, where the number 5, 4, 3, 2, 1 is the percentage of the unpaid balance that would be due in that year of the loan term. And you can see that gives you absolute certainty as to what the cost of an exit would be in any given year during your business plan.
Perfect. Thank you so much. That is, well, first and foremost, great explanation. I feel like I learned a lot from that. But secondly, it just proves to me more and more that if me or people I'm working with need loans, we need an expert like you who knows how to navigate all of these different variables to make sure that the right tool is being chosen for the right job, essentially. So, yeah, very good. Thank you for that. You gave me enough to make me think like I know what I'm talking about, but probably just enough to be dangerous.
And that's what I would say is from a limited partner standpoint and from a general partner standpoint, if your lender is not, or even if you're working through a broker, we're a direct lender, but occasionally borrowers will also work with a mortgage broker before they come to us rather than coming directly. If your lender or broker is not asking the questions of you about your business plan and having this conversation about prepayment and structure and term, whether it's 5, 7, or 10 or fixed or floating or whatever, then the GP needs to make sure they are initiating those conversations, because they're not unimportant conversations that should be glossed over.
That's the challenge that we've seen. We've all heard about this Houston situation where some properties went back to the banks, and the banks don't want to take these properties back. They're not asset managers. They're not property managers, they don't have any desire to do that. So they're underwriting situations to make sure that they don't get the assets back and that it is the right tool. But the reality is a lot of assets were underwritten and loans were made on properties that probably should not have been made. So we're starting to see some deals bubble up that either it's mismanagement or a bad loan or no cap or a combination of all the above, are creating some situations where passive investors are losing capital. So it's really, really important to be working with partners that are making these types of decisions with all of the facts, with great partners, and are not just trying to slam deals and drive acquisition fees to pull out of the business. So yeah, very good. Well, let's see here. I'm curious. There are some other things that I think are interesting as well, where as a passive investor, you hear people talking about um, at risk or EMD dollars, or possibly being a key principal on deals, but other ways for passive investors to kind of put their dollars into a deal and potentially get some other returns. Do you have any experience or knowledge about those areas as well that you could share?
Yeah, somewhat. I mean, I think at the end of the day, there are a couple different reasons why someone might want to be what you mentioned, a key principal on a deal. And that might be maybe they want to start building a track record of signing on loans and be somewhat familiar to a bank or to Fannie Mae or Freddie Mac, and that's a legitimate reason. The other would be the GP needs additional balance sheet or something, and they're going to bring an LP on to sign on the loan as a key principal, and in return they're going to offer some sort of compensation or something like that. I think it's important to remember that you can have as many KPs on a deal as you want if you're a GP or a borrower in general, but you also don't need to have any more than necessary to demonstrate the strength of the team and whatnot. So I mean, I've done deals with 12, 13 sponsors on a deal, and I've done plenty of deals where it's just one general partner, one owner carrying the entire deal. So there are different reasons why someone might be interested from either the GP's perspective or the LP's perspective. It just comes down to the deal you strike and if you're going to be compensated or if you're going to get the experience or whatever. But the important thing I think to remember is that when you sign as a key principal, you are coming in and accepting risk. So if you want to be compensated for that in experience or in capital, take your pick, but you are accepting risk.
Okay. No, that's a really good point. And so, and the backdrop to that is, my understanding is the GP needs to have net worth equal to the loan amount. Is that correct?
That's correct. Yep. Generally. And that's not just with Fannie Mae or Freddie Mac. That's a pretty standard guideline around the commercial real estate industry. Some lenders are a little more flexible on that than others. Once you get up into very large deals, 15, 20, 30, 50 million, that's not necessarily a hard requirement. But in general, particularly for lower balance loans, let's say below 10 million, you're going to want the sponsorship team to have net worth equal to or greater than the loan amount.
So that brings up another question. I'm sorry, I'm just firing questions, but this is prompting a bunch of these. So you get a lot of these super GPs or mega GPs, whatever they are. They might have 10, 20, 30 different assets that they have taken down over the last decade or 2 decades, whatever that is. When the bank is looking at their, I'm sure they're looking at their entire portfolio. And if they're signing on the loans, do the banks know, or do they care to know how many other loans that they are signing on as well? Because essentially that would spread the bank's risk across more assets, I would assume, right?
Exactly. So we look at a schedule of real estate for every sponsor that we underwrite, and we will look at not only their role in those other transactions, whether they were a GP or an LP, but also we'll look at whether those loans are recourse or non-recourse, because that makes a difference as well. Of course, when you really drill down into it, you'll also look at the prevailing loan to value of that transaction, the performance of the properties, whether they're cash flowing or whether they're, under rehab or construction or something like that. And all of that matters to a credit team when we're looking at a loan and saying, if we have trouble with our loan, or if there's a deficiency for 1, 2, 3 months in the cash flow of our loan, what's the likelihood that this sponsor is going to be able to step up to the plate? Do they have cash flow coming from other properties? Or is this cash flow from this property going to be supporting the rest of their portfolio that's not performing?
Okay. Yeah. So there's many, many different layers of this onion many that we uncovered here, but probably many, many more that we haven't even discussed. But that's been really, really educational for me. Thank you. So very good. So yeah, like here we are at 30 minutes, and I say this almost on every single show. Like I wish I should probably extend these, but I want to be sure to be sensitive to people's schedule. But really, really insightful. I appreciate everything that you shared. I do have a few questions that I like to ask everybody. And before we transition over into those, I'm curious, is there anything that we didn't discuss today that the passive investor, either you can share real quickly or kind of point us in the direction of other things we should be looking into and trying to get educated on, so we have everything we need, or at least a good portion of what we need to make a good educated guess on these assets?
Yeah, good question. I think there are a couple of recommendations that I would have for passive investors. I mean, number one is just don't blindly invest in anything, whether it's oil or stocks or small businesses or real estate or crypto or whatever. Just don't blindly invest. Don't blindly throw your money into something. And so get educated, obviously, understand income and expenses, understand, occupancy and minimum level of lender requirements. And, you would know if your GP was pitching a 5-year hold with a 10-year loan with yield maintenance, you might ask the question, hey, what's the plan here? How are you going to exit this in 5 years? So get educated. Don't be passive about your money. You can be passively invested, but don't be passive about how you're treating your money. The other thing I would say is invest in people, invest in character. I mean, it's obviously a wide spectrum, like anything when we're talking about people, but there are a lot of people out there that are, like you said, chasing acquisition fees, and there are a lot of people out there that are doing deals, and they've made deals happen, but they don't necessarily know what they're doing, or they don't necessarily roll up their sleeves and get things done. And I think if you spend a little bit of time figuring out the GP's, character, and are they a hard worker? Are they conservative and prudent? Do they make smart business decisions? Do they move forward slowly and methodically, or are they just chasing every deal and putting offers out and buying whatever sticks? Or are they doing 25 deals in a year, which is really, I don't know how anyone could manage that. So there are many different, flavors of general partner. And I think it's important, unless you really are, very risk tolerant, then you probably want to invest in, someone who's hardworking, conservative, makes smart business decisions, focuses on asset management before they move on to the next acquisition. So, that would be another piece. Is it's not necessarily about the deal. I would feel better investing in, say, a 15% IRR deal with someone who I know I can trust, that if they're sending me this deal, this is a good deal because they've done all their underwriting, they've vetted it, they've spent weeks on it, rather than someone who tells me it's an 18 IRR, but I know they're the type of person who's running around with their head cut off, looking at every deal and trying to make every deal work, right? And the third piece there is, and I say this, but most of us in the industry, like myself, the professionals, the people that have been around a long time, passive investors that have been at it a long time, passive investors that might have been developers or GPs at one point, but now they just want to invest passively. Talk with them and figure out who they're investing with. Those people are going to have a track record, and they're going to have expertise at analyzing deals. And whoever they're investing with is probably going to be someone that is reliable to put your money with. So as an LP, those are kind of the things that I would focus on.
From a guy with a lot of years in the space, you've seen a lot of good and a lot of bad and the ugly, I'm sure. So yeah, thank you for that. Very, very well said. Well, let's do this. Let's move on to the next phase of this, where I ask a few different questions here. I'm curious, again, as this is always geared towards the newer passive investor, are there any particular resources or books or podcasts that you might suggest for our audience to pursue to continue the education process?
Yeah, there are a few. I mean, I think this podcast is definitely a good one. So, I mean, if you're having folks like me, if you're having other passive investors who are sharing, positive or negative experiences, like all that's great information for people that are looking to invest passively, particularly people that haven't done it yet, but are trying to get a lay of the land and figure out how to think about it. I've been behind on my reading lately. Just been a little too busy, but I think one book that I think is just if kind of a fun book, but also required reading for anybody looking to build wealth and think about money is The Richest Man in Babylon. And it's a quick read. It's a fun read. I mean, you could read it to a child and they wouldn't necessarily pick up the lessons, but they'd enjoy it. And I think that for me would just be kind of required reading. And then there's another book that's pretty basic, but The Millionaire Next Door is one that, particularly for passive investors, it shows that you don't have to do anything fancy to become wealthy. You just have to kind of follow the path that's been paved and do the right thing and be thoughtful about your money.
I love it. I read that book probably 20 years ago, and it's as relevant today as it was then.
Yep.
And the thing that always comes out, I don't even know if JCPenney's is around, but they talk about the guy who's wearing, Levi's jeans or the JCPenney suit and driving the 15-year-old car.
Yeah.
Very great recommendations, both of those. I love The Richest Man in Babylon as well. Yeah.
The quote that I remember is, I remember in that book when they were interviewing, they set up this really nice like charcuterie board for all these wealthy people. And the people that came, they were wealthy, but they were kind of self-made wealthy. And they came in jeans and sneakers, and all they wanted was the cheese. They didn't want the fancy wines. They didn't want the fancy meats. They just kind of went for the simple stuff. And one of the lines in the book is, do you want cattle or do you want a big hat and no cattle? That's as true as it gets, really. Is it how you watch your money is going to be reflective of where you ultimately are going to go.
I love it. You are speaking my tune, man. It's not how much you earn, it's how much you keep and invest, right? At the end of the day. That's awesome. Yeah, thank you for that. That's refreshing to hear that in the REI space. You might not, because I joke about keeping up with the Cardones. Like everybody's chasing the jets and all the other stuff, but like the simple life with financial freedom where your expenses are covered by your passive income is just an amazing, amazing place to be. And hopefully, we're doing more to help educate people how to get down and closer to that path. So, well, very, very good. Kind of a fun one here. Is there a recent bucket list item or a bucket list item you hope to be checking off your list in the near future?
Yeah, good question. I don't really think too much in those terms, but I may be making a trip to Croatia in the next couple of weeks. I got an invite that I haven't quite decided on based on my schedule, but I may be making that trip. I don't know. I guess another upcoming one this summer is my niece is 3 years old, and she's going to be up at the lake in Maine with my folks for almost 2 weeks in July, and I'm planning on heading up there and getting some one-on-one time with her, and haven't seen her in at least a year. So that's kind of short-term bucket list, but
I love it. Yeah, no, family and travel, kind of the two big ones on my list as well. So thank you for sharing that. I appreciate it. All right. Well, thank you so much. This has been a really great conversation. You bring a lot of education to this group, and it's something that's not often talked about. It's always just make sure they have a good loan. Well, what does that mean? So thank you for shedding some light and educating our audience on that. Thanks so much, David.
Of course.
And to the audience, as always, want to continue to encourage you to focus on your education in this space. But just as important as that, I encourage you to make the decision to invest in your first passive investment or your next passive investment deal as soon as possible. Make the decision to do it and jump in. You don't have to put a very large amount of your dollars into it, but once you get some dollars in the space, you'll start to become educated more and more and more. So we think the faster you do that, the faster you'll decrease your dependence on your W-2. And I'm pretty convinced you'll be happy that you did start once you get going. So to our listeners, as always, thanks so much for listening, and join us again next Thursday for another great episode. Thank you.
Well, there you have it, ladies and gentlemen, another episode of The Gentle Art of Crushing It. It was an amazing episode. We know we sure learned a lot, and we hope you did as well. We want to take a second and thank you so much for viewing or listening to this episode. And please just know that we only ask for one favor, and that is to make this life magnificent. Thank you, and have a wonderful day.